Jesse's not gonna do anything
Well,
too
he may
upsetting.
throw something at you, so be prepared for that. But nothing too serious.
I've tried to binge as much of his podcast as I could in the last week to kind of get an idea of how his brain works. So
I'm still trying to figure it out.
yeah, I jumped on this because it is something that I've looked into and something that I've done some research on and have some thoughts on. So I jumped on hoping I can provide value in this. But I'm also open to being like, hey, dude, you're thinking mainstream. You're not thinking IBC. So I hope there's some open discussion there.
Yeah, from my looking into it, I was like, oh, if I would have found this prior to IBC, I probably would have started doing it because I had a lot of the structure in place.
Okay. All right, listen, Rob, stop talking.
All the content's coming out too quick.
Seriously,
Oh, God.
I'm telling you. See, this is good because this is just how it happens. We jump on here and then we're all ready to go.
Fantastic, fellas. We've already been chatting it up a little bit, but how are you this morning? Let me do this just because we are jumping in with some new faces to our round table series. Let me do some introductions now for everybody that is tuning in. If you've not yet been introduced to these fellas, make sure to go to our interview series where everybody here has sat down with me and shared their own personal origin story with infinite banking and what they're doing today. So Rob, David, Adriel, look them up there. But as a way of introduction on this particular roundtable series, y'all, let's give a brief recap if you would again. Rob, you're a perennial visitor, have the perennial seat at the round table, but tell everybody good morning and where you're from.
Yeah, good morning. Rob Brayton. I'm from central Wisconsin, and I have been an IBC practitioner for the last year or so, and it's been an awesome journey, but was able to really get into the infinite banking space roughly about 2.5 years ago, and just saw the amazing work that it was doing for my family and knew what I wanted to do with then as a result of that, to be able to help other people. And that's what it's all about, is helping others and seeing them grow, seeing them have this, hopefully the same level of change that I've experienced in my own lifetime, and provide that for them too.
Absolutely. Or more, right? Because we're always having these kinds of conversations and cultivating what it is that we're personally doing and how we professionally help other people. Fantastic. I love it. David, how are you this morning?
I'm excellent, Jesse. So I hail from this great state of New Jersey, and how I've been an IBC practitioner officially for the last year and a half, but had been practicing for the last 7 years. And I come from the world of Wall Street because I'm no more than 20 minutes away. And that's where I cut my teeth in the financial services industry over 30 years ago. And what the missing link for me in how I'm servicing my clients is that protection is paramount and foundational. And IBC, I just happened to stumble on it during COVID. And I wish I'd known about it 30 years ago. And I appreciate being on the panel today.
Absolutely. Adriel, good morning. How are you, sir?
Morning. I'm doing pretty well.
Fantastic. Tell us a little bit about where you're from.
All right. I'm from southwestern Wisconsin. The other guys gave a little bit of their background in the financial services industry and that stuff. My background is simply family business. And we discovered infinite banking about 4 years ago, and I really took an interest in it, and I'm working on becoming a practitioner. I'm definitely the new kid on the block here in this panel, but I'm really happy to be here with you all.
Absolutely. You've already been stirring the pot. I couldn't help but I'm sure it'll be in the extras or the bloopers of this episode. I was still reliving your New Jersey, New York comment to David in my mind while he's saying where he's from. So awesome. Well, let's jump in on this first subject then. This is a bit atypical. Y'all know this. When we show up to the round table, there's a lot of times no telling where the conversation is going to go. We just have organic conversations, and normally a theme or two pops up. But I did know that I wanted to field a conversation around velocity banking and or versus infinite banking. And for a few reasons. One, because people have questions, because of how the algorithm works when people are learning about infinite banking, or it's the opposite, right? And I'm looking forward to y'all's conversation and y'all's perspective and input. Like, some people find infinite banking that exposes them to velocity banking. Some people find velocity banking and then that exposes them to infinite banking because of the algorithm and the interwebs and how that works. So I know that I have prospective clients that when we're having consultation calls, they will oftentimes bring up questions. Hey, Jesse, what's your experience about this? What's your thinking around this? And we have discussions on it. So since other people have this, these questions in their mind, I thought, what better way than to try and field that here at the round table. So let me kick it over. Rob, why don't you jumpstart us off with anything high level where you would speak to velocity banking? If I can, as I do kick this off, if I recapped infinite banking, I would say, well, first, it's a thought process that leads to an implementation of a way of doing personal finance with a particular product in a systematic way. All right, just to try and give a sentence or two about infinite banking. So the thinking behind infinite banking is going to be a very set number of principles: thinking long range, intentionally capitalizing over that long range, okay, not doing business with banks, being an honest banker yourself, constantly being willing and actively rethinking your thinking, and preparing for windfalls. Okay, so those are principles that folks learn about from our Nelson Nash, Becoming Your Own Banker, this idea of infinite banking. Okay, those are the principles behind the concept. Now, the process is just privatizing banking instead of commercially doing banking. Typically speaking, we make our deposits at commercial banks. That's where we make our withdrawals from if we're paying cash for things, because there are two ways of doing conventional finance. You pay cash or you use credit, right? So we make our deposits there, then we make withdrawals to pay cash for the things that we want to do, or we're taking loans from that commercial bank if they approve us, filling out their paperwork, paying them interest to do so. They're holding some form of collateral over us, etc., right? So cash or credit, those are the two ways of finance. Infinite banking takes that commercial way of doing things where somebody else has control and profitability, and it privatizes it. So me, Jesse Durham from North Carolina, I have a private family banking system. Okay, so that's the process. Okay, so I intentionally am paying a premium, capitalizing, putting money towards this family banking system. And then I use that family banking system for my access to capital instead of the commercial bank. How am I doing so far, right? Y'all are nodding your heads and stuff. Good. Okay, and then that leads me to the product. So I'm trying to share the principles, the process, and now I'm giving you the product. The product is a properly structured whole life insurance policy contract from a mutual company that pays dividends. That's where we capitalize, in that product. And when you do it with one, you can do it with more. So I personally have 7 contracts so far. I'm building a system just like banks open up multiple branches. I've been building a system of these policies. They are the product that I use for this process because of the principles that I want to apply. All right, so that's just my brief recap on infinite banking to try and set the stage here, to be able to contrast it with infinite banking, to be able to point out the aspects of where those two philosophies can have congruency, actually. So I don't want to say too much right there, but here's infinite banking. I tried to give a description for it. Can you give us some high-level points about velocity banking?
Jesse, I could speak into, because I actually have meshed IBC with velocity banking, like not even consciously knowing that I actually was combining the two as I've designed policies over the last few years, where in my fact finding, again, I will figure out what someone's, let's say, what their living expenses are on a monthly basis and design a policy that can incorporate the attributes of both velocity banking and IBC simultaneously.
Yeah.
So unbeknownst to myself, I've been doing that. So I think that's what you're going to be wanting for me to discuss.
Yeah, and I had maybe a philosophical thought on the similarities between the two and kind of like how both of them could be described, how the process could be described in one short sentence. So I don't know if.
So do this for me. I don't care who jumps in right here. Give me a description of what velocity banking is at a high level is fine. What is velocity banking? And then let's talk about the similarities and the differences.
Okay. All right. You want to go first? All right, I'll go first.
Oh.
So when I started looking into IBC, I kind of found velocity banking through that route, like you said earlier. And what I discovered was velocity banking seems to be the most efficient way to build equity in an asset using a debt instrument as a liquidity buffer. I think that would be the easiest way to explain it. Using that line of credit to lump pay an asset down and then using that line of credit to cover your monthly expenses, cover your liquidity.
Would you just say what you just said again? I was trying to write down that line. Just say it again. No changes.
All right. Velocity banking can be thought of as the most efficient way to build equity in an asset using a debt instrument as a liquidity buffer. Or another way to say it could be to put 100% of your income towards an asset using a debt instrument as a liquidity buffer.
So, I mean, of course, I can already see one point just from what you said right there, Adriel. I mean, I see a few, and I want to talk about all of them. But one point about a contrast, say, between infinite banking and velocity banking, in that Nelson says when it comes to infinite banking, the idea, eventually, long range, it does not happen overnight, is that you can get premiums to equal your income. So that's something that you systematically build up towards. So like I'm in a category now that's different than where I started. When I started infinite banking, I paid a significant percentage of my gross cash flow towards my very first policy, very first premium. Me, it was significant. However, now I'm in a category of more than half. So the lion's share of my gross cash flow goes towards my system of policies that I've built. But again, I've been doing this for 10 years now. So that's been something that I've progressed towards, right? Whereas one thing that stuck out to me about velocity banking that you just mentioned, of course, is that the idea is perhaps quicker in its implementation by getting a greater percentage, maybe all of your income or cash flow into that debt instrument sooner than you could a policy or a system of policy.
Right.
So that could be a pro or it could be a con depending on how you look at it.
There's no
definitely-
capitalization phase, right? There's no capitalization phase. It just, you can implement it overnight. Where with infinite banking, there is actually that capitalization phase, but the dividends are just huge in the future.
Okay, so thanks. So we're about to get into the nitty gritty, and I'm ready. Thanks for giving us a high level. Rob, do you want to give us another high level perspective on what is velocity banking?
Sure. So I took a look at a few different things to get a little bit of information, which may or may not be dangerous. Who knows? But I did look into like the origins of it, and it sounds like, and from what I can tell, and this ties into what Adriel was saying as well, but there isn't like a single origin for this concept or this process. But from what I'm seeing, it was evolved from some Australian mortgage offset strategies and some US debt acceleration type tactics. So, and it was then popularized by, a few different people in the real estate space. But a lot of it is really about trying to reduce, some of the interest that's paid to banks by leveraging a home equity line of credit. So you're sweeping a lot of income, so to speak, into the HELOC in order to chunk down your other debt and create use that HELOC as a form of liquidity, much like what Adriel had said before. So it's to really create a more short-term strategy for gaining more liquidity in your properties, in your assets, so that you have the ability to then leverage and use those things for other asset accumulation, using, you know, a property that, say, you 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 have a property that has a lot of liquidity in it. You take out the HELOC, you pay off that mortgage, or you pay off that item, then you go take out another, you know, you can use that property towards down payment for another property. Like, those are some aspects of how it can be used, or has been used. And then also you could use it for just trying to wipe out your debt as a whole. Um, the challenge that I've seen with it, though, is that it the banks control, you know, the bank's the one in charge, right? And those of us who kind of subscribe to the infinite banking concept, becoming your own banker concept, we understand that when banks are in charge, they're the ones who control everything. And infinite banking is all about control for you and me on the personal level. So that's where I see there's some challenges, where, you know, a bank can simply say, hey, we're coming on hard times, we're freezing all the HELOCs, you got to pay this off. Like, that can and does happen. So not saying it's going to right now, but like it has happened in the past. So just one of those sort of thoughts that come into play of, that's the structure, that's how it tends to be used, but what are you really trying to use it for? Could that strategy work for somebody in the short term? Absolutely. Like, I can certainly see, and I know I mentioned this a little earlier, but had I found the term velocity banking prior to infinite banking, I may have done some of that myself at some level. It's very possible. I did use my home equity line of credit for some things, but I didn't look at it as using it in that manner. So I certainly could have, had I not been informed enough. But now, once you have this wider level of understanding of what's going on, so like Nelson says, when you know what's going on, you know what to do. It's like, well, I'm really glad I didn't find that before I found infinite banking. So
Yeah.
It's pretty interesting on that front.
Yeah, Rob, you mentioned the using a home equity line of credit as the debt
Mhm.
instrument. There's actually a subset of infinite
Okay.
banking that actually uses, or of velocity banking that actually
Okay.
uses a personal line of credit.
Okay.
And then you're
Yep.
actually using that and locking up more equity in the home that you can't access.
Got it. Okay. That makes sense too.
All right, say that one more time about the personal line. So the personal line of credit is another way to be able to have a creative access to capital. And then you and I spoke about another one as well the other day, Adriel, just in a phone conversation driving, about the a first position lien. Do you want to speak to any of that anymore?
Yeah, so we found out about my family. When I say we, I mean my family. We found out about infinite banking and first lien HELOC strategy at about the same time. And so my dad implemented both of those in his life at about exactly the same time. So it's really interesting to see his thought process on which instrument he uses for what purpose. Yeah. But the what I wanted to go back and say with the personal line of credit thing is, your home can be a liquidity jail. So if you're using a first lien HELOC, you have access to that equity. If you're using an outside debt instrument as your liquidity, then you're actually using that to just lock up more equity quicker. If that makes sense.
I have thoughts. I have feelings. Go ahead, David.
Adriel, I'm curious, did your father use the strategy of using his cash value life insurance policy as collateral to be able to secure business capital, which I've done for my clients
Yes,
over
he
time?
has been. Yeah. But he's kind of using the HELOC as his velocity banking source, and then using the life insurance as more of a secure banking function.
Got it. No, what I was going to say, Jesse, is that my understanding is that velocity banking can be married with infinite banking in a way where if you first implement velocity banking, that frees up capital to be able to continue to finance your IBC system. Because now you're taking dollars that would have normally been designated towards a debt instrument and creating a pool of capital that now can be leveraged to be able to actually help you to, because I was thinking about page 48 of Nelson Nash's book, where you want to create a system where you accommodate as much of your income. And that's where I feel like there's a marriage between the two concepts that I have just unbeknownst to myself have been implementing for my clients. Didn't know there was a name to it till, I started being exposed to it, velocity banking, married with IBC.
Mm-hmm. So I appreciate you saying something more about Nelson talking about income, because it strikes me that I have, and I don't know when this happened, but I have changed how I speak about how premiums can increase from our cash flow. And I'll say cash flow instead of income, because there are business owners and people that do creative things with access to capital in other areas that allows them to have access to capital to pay premiums. So I think having the mindset of, because a business, for example, its cash flow is a larger number than the income that let's say somebody experiences from the business, because they have expenses, they have taxes, they have overhead. So we shouldn't ignore what the total cash flow is that an individual or a business or whatever has when considering paying premiums into policies that are going to be owned, and only limiting ourselves to income. But I know that, becoming your own banker, it was made for the layperson, and that could definitely just be for somebody who has a career, somebody who's working their job, and they do have a set and a standard and a W-2 income, But I think that's one important thing that stuck out to me that you made me think of when you were talking about income is I love looking at cash flow. I love being creative with finance. And I know that there have been different things along the way, whether it's debt consolidation programs and stuff. So I'm not saying one way or another that this is good, that's bad so far. I might say that about something specific. I think people ought to do what they want to do. If they want to implement infinite banking and they want to implement velocity banking, who am I to tell them not to? Or to say, oh, that's a bad idea? I don't mind having a discussion. I don't mind asking some questions that I think will lead people to form, maybe new opinions by having new insights. But I think people should decide to do what they want to do. But I do have some philosophical questions that maybe I want to ask. So we've given a description, and if I used it again, let me run this back by you and maybe let me pick at some things and ask y'all some questions. If velocity banking's an easy way, let me pause right there. How easy really is it to secure access to capital using anything that we've described so far, or any other way that anybody would implement velocity banking? Getting that HELOC, getting that first position, personal line of credit, whatever it is, what does that look like? What should people be aware of? What should they think about when it comes to that aspect? How easy is it to establish that and or maintain that?
You're dealing with banks, so it's not that easy. Is the short answer.
And that's what sticks out to me is like there are going to be some hoops to jump. There is going to be paperwork to fill out. There is going to be permission asked. That one is maybe where I get a little pricked.
Yeah. I know in my dad's instance, he went to the bank and said, hey, I've got this idea. And we have a really good relationship with our local credit union. Their first answer was, we can't do that. When he went to get that first lien HELOC. A little bit more talking through it and stuff is like, hey, we can do that through the business side of our bank, but not the personal side. So that was some hoops he had to jump through to actually get it done.
I appreciate you mentioning that. I think that's relevant for anything that people want to do. Like, how much educating do you want to do with any professional? Like, How much educating do I want to be doing to my medical doctor, to the dentist, to the car mechanic, like to any specialist in any area of my life? Like, and that's relevant for us in that people learn about infinite banking, land on our calendars, want to have a conversation with us. I never want somebody that's getting on my calendar to feel like they have to educate me about infinite banking. Right? That's not the case, right? And I've never had anybody tell me that they feel that way. But what I'm saying is there are people out there that use the words infinite banking, and people are lending on their calendars, and they can know if they've like actually gone to the source themselves, right? They can know more about that individual, or maybe they're even just trying to go to their box store insurance agent and saying, hey, I want to do this infinite banking idea, and I know that I need an insurance agent to get whole life insurance. And then they're in a position of trying to convince or coach or, instruct the professional about what it is that they want.
CPAs.
You just using them as an example?
Yeah. Just it's difficult to find a financial professional in any realm that says, yeah, your infinite banking idea is a really good idea.
Yeah, getting them to understand it. Well, I mean, they're like anybody else. They got to go right to the source. All right, so there's some steps to get the process going and established. Having creative access to capital. Okay, let's talk about that efficient part, because I have some issues with the efficient part. So I get it. Okay, let me tell the part that I get it. I get that somebody could say, well, if I want to, get 50%, 75%, 100% of my income into this debt instrument, I can do that in an efficient way. Meaning I could probably do it right out of the gate. I could probably get a half or more of my gross cash flow into a debt instrument to start building equity, right? To leverage or whatever. With a policy, if you're applying for a policy to implement infinite banking, and you say, oh, well, I want to take 75% of my income and put it in premium, that's going to be a problem, right? Insurance companies aren't ready to do that. Okay, it's a problem. So I get that if you compare those at a high level, this one seems more efficient. Oh, I can do it quicker. But my question there is well, okay, and I've got this mental visual of I put money in, I take money out. Like if I walk that out trajectory, where do I end up? Let's say I'm doing something to pay off debts, right? I'm paying too much debt on a myriad of things. The car, the boat, the student loans, the credit cards. Let's say I decide to do this velocity banking. Like what is at the end of that trajectory? All right. I'm just putting it out as a question. I have my thoughts, feelings, I'll share them, but I'm putting it out as a question. And then compare or contrast that with, well, if I, in a dedicated fashion, proactively capitalize in policies, visually, that's going to look like a compound growth curve. Period. I know it's going to look like that. That's a guarantee, actually, that every day the value that I've created there is also very efficient. Let me go back to that origin word that I'm trying to point out to us right here. That's very efficient. Now, there is a dip in liquidity, never a dip in value when you start a brand new whole life insurance policy, right? Like if I pay $10 in premium, it's not going to create $10 in a liquid number, in a value that I can leverage 100%. No, that is not the case. It could be 2, it could be 8, it could be 5, but it's not going to be the full $10, right? So in that way, you could say, okay, well, that's not very efficient. And there are people that say that. There are people that say that very strongly, okay, in their thoughts on how to build policies for infinite banking. But depending on how long we want to walk out that trajectory, well, what are my results going to be? Well, it's going to be very efficient. Those dollars in the future are going to be creating multiples of themselves, 2 times, 5 times. I mean, multiples of themselves. It's very efficient. Let me pause with there. I've said a lot, but I'm trying to kick it back to y'all. What are your thoughts about the efficiency aspect of velocity banking versus infinite banking, and I'm still welcoming with infinite banking. You could be talking about the combination of those efficiencies in those two approaches.
Yeah, I'll jump in first, I suppose, on that question. So when I think about efficiency, um, I look at it as if I'm trying to wear the hat for the mindset of why someone would say it's efficient, and to use your example, Jesse, of having all these other outstanding debts, I can definitely see how it creates efficiency in the payment structure to repay all those items, right? A HELOC has a different repayment structure than a traditional mortgage. So more of your money is going to go to principal. You're going to be able to pull that debt down a little faster to a degree. Now, I would argue a little differently to a point because I have, although I'm in the process of getting rid of it, but I have a home equity line of credit and I see how much is going to interest, and it's still a lot. So even though that rate is whatever they claim it is, right? But when I look at the volume of it, it's still very high. So I don't know that there's really a lot of efficiency there, but I think if you're in the traditional financial mindset and you're only looking at rate, you're not thinking about volume, it feels more efficient to a lot of people to consolidate in those ways. Additionally, when we think about Nelson's rules, you know, we think long range. Does this concept fit into thinking long range? And I would certainly say it doesn't. It's very much a more short-term focused way of handling a lot of these financial aspects. And from an efficiency standpoint, if you want something to be truly efficient, you do have to think on a more long range basis. At least in my opinion, you do. So sure, you can jump in and go do something, but you can start doing a lot of these different strategies, and it seems like it's working well, but at what cost? There's always a cost. So you're giving something up, which in this case would be long-term capital growth. What's the cost of that? You're giving up the control. So how efficient is giving up the control on a system? I don't think that that's really efficient. So there's aspects to it and how you want to look at it. And a lot of it comes back to what's my view of the financial system to begin with? Do I understand the full picture? If I do, I'm going to look at this a lot differently than if I don't. And if my only focus has always been in this, traditional banks have capital, I don't, that's who I have to go to mindset, well, then I might look at that and say, yeah, this seems like a great strategy. But once we kind of look at the whole picture, then we start to see, oh, maybe there are other ways that I could use this a little bit differently. And I think what David was talking about earlier of kind of leveraging or marrying two concepts together, I think could somebody use, if there's, I will say first and foremost, somebody has to be disciplined. If you are not disciplined, you shouldn't be doing any of these strategies. But if you have the discipline, can you leverage or utilize this one in the short term because it actually has short-term implications along with a long-term strategy? Maybe. I tend to be more of a purist, and I'm like, I don't want anything to do with a bank. Nelson's fourth rule, don't do business with banks. Granted that's something that takes time. That isn't something that happens overnight. So sometimes we have to use a bank in the short run. So we can do that. And maybe it is more efficient to do that. And again, this isn't to say that all velocity banking is bad. I don't want anybody to think that that's my perspective. It's more so, I think certain strategies have certain places, and we have to be thinking about that when we're thinking about the efficiency game. And what is the long run efficiency that we're actually trying to achieve? If I know what that end goal is, well, what's most efficient in allowing me to achieve that end goal? And then maybe it incorporates both, maybe it doesn't incorporate one or the other. And you have to think about it that way.
You reminded me of a very grounding thought in this kind of a conversation, Rob, which is the idea of compared to what?
So
I feel like I might have been too negative sounding, so I want to make sure that I'm not too negative sounding about velocity banking. Again, I think people ought to do what they want to do. I don't tell people do this, don't do that. You do what you want to do. I share best practices, answer questions, we have a discussion, conversation, share my experience, etc. But what did I want to say there? But comparing it to what if somebody is in that conventional mindset, I think is how you said it, that conventional financial mindset, I think they will see the efficiency and the ease of use of velocity banking compared to just using the credit cards or paying the regular car notes and that kind of stuff. It can simplify some things. Okay, I've got this one debt tool, right, that the bank does control and profit from. But I've got this one tool, that's my main source. And I've got these clients. I've got clients that come to me and they're a business owner and they are, moving six figures on a regular basis in and out of a line of credit somewhere to do their business. And then they learn about infinite banking, right? And then we're making that pivot of where are we building capital? What are the long range implications? What protection is provided? All that kind of stuff, right? We're exploring and then implementing something to account for all of those things. But in the short term, I can see how velocity banking can make a difference for people's short term situation. I think, again, I would definitely underscore what you said there about the human problems. Like, no matter what the tool is, it always matters whose hands are the tool in.
Yeah.
Right? You could build or destroy with a hammer. What's the intention of the person behind the hammer, right? It's like, what are they actually going to do with the thing? Because the hammer could build or destroy, but what's the intention behind the person? How are they going to wield it? How are they going to use it? Do it well, do it poorly, whatever, right? You could smash your own thumb with a hammer, right? Even regardless of what your intentions are. Like, you could be trying to do it right, but, so anyway. I was not trying to speak too poorly about velocity banking. Jump in there, Adriel.
Oh, I had a couple of thoughts. One on what Rob was saying about efficiency. I was on a call with Bruce. I think you were all there. And I said something about efficiency in life insurance policies. And Bruce was like, whoa, whoa, whoa. Hold up. Efficient compared to what? Like, what are you comparing efficiency to? What's your efficiency number? Is your efficiency number future growth? Is your efficiency number mode of premium? Is your efficiency number rate of interest? What is your efficiency number? What is the thing you're looking at? But then what you were saying about the tool just reminded me of Nelson's quote. You can put the best tool in the hand of an incompetent, and he will either not know how to use it or he will break the tool.
Yep.
That's good. All right, so if we couple those two things that you said right there, and I think it's very relevant, right? Because if we talk about policy structure, for example, I think that if you swing the pendulum really far in one direction to where base premiums are really small, skinny, weak, itty bitty, and the PUA is large, you're trying to push towards that realm or philosophy of, well, I want more efficiency. Like that's the idea behind that. But again, so many questions then come into, like I had somebody on my phone yesterday asking me, Jesse, can you mech a policy by taking policy loans? And I'd say, well, yes, you could. You could mech a policy by taking policy loans, right? What's the design of that policy? Does it have, is it too fragilely built, right? Are they going to break the tool is what I'm addressing right here, or trying to, Adriel. If that's got a skinny base and there have been significant policy loans taken, but no policy loan repayments, no addressing policy loan interest, have we been trying to max fund that policy? So maybe if we're not even max funding are those steps that weaken the tool? Yes, they are. And the use of that tool can weaken the tool. So I feel like I'm layering lots of things on lots of things compared to what's important, who are the actors in the play? That's something else you made me think of, Rob. At the end of the day, HELOC, no HELOC, line of credit, no line of credit, first position this versus whatever. Like, isn't the bank winning in all of those? Because those are products that the bank is, just leeching money off of us and our families from those things.
Those are all dollars that flowed into your system and flowed right back out again, and you never got any other use. You bought the thing, you consolidated debt, you generated more equity in a different property, but at what cost? Like, all that money still flowed through your hands, and you don't have anything other than the properties that were already involved that you potentially had at least an ownership stake in at that time. And in this case, we're actually creating another asset where you're building a large amount of equity in it over time. And the resounding rule that's been banging around in my head as we have this conversation is, don't be afraid to capitalize. And I see these strategies as being afraid to capitalize your own system. We're going to leverage someone else's capital as opposed to creating our own capital that we can value and use in a different way. And then not only that particular situation, but then you have what happens in the future. Now somebody has all this debt potentially from these systems. Maybe they've been able to knock them down and they have enough assets to cover it. But what happens with it, when the worst happens? And I think that's the thing to think about is, and James Nethery says this all the time, it's never a problem until there's a problem. Well, what happens when there's a problem? I mean, who's in control? The bank. And what are they going to do? I don't know that I want to know that. I don't want to be in that situation. So there's so many of these things that we have to keep thinking about. And it's really just, and this is why I love the way Nelson did this, and I can realize his wisdom is focusing so much on the human factors of the infinite banking concept as in understanding our own mindset. How do we think about things? It's all about how you think. And that's, we have to continually rethink our thinking to better understand what's the best route for us to go. Right now, it might be this. Later on, it might be that, because I renewed my thinking, because I thought differently and think differently now, I see that there's a different option. But if we're only staying in the traditional finance, we have those blinders on, well, where am I going to go? I can't see anything else because I haven't rethought my thinking about finance, about all these different strategies that may or may not exist. So just something to think about on that front again.
So you guys have stirred a lot of intrigue into going down the rabbit hole. What I have found is that there's always a very intentional fine line that we all as practitioners need to walk when it comes to re-educating people about rethinking their thinking. Because invariably, and I don't know if you guys have experienced this, that I've had many people that have come to me that are thinking about a lot of these ideas somewhat very short-term oriented in their thinking. And what I think a challenge we all have is with the rethinking of the thinking is we want to stay away from, a lot of people are seeing their eyes and their ears are being filled from different social media and such, where IBC is one thing or velocity banking is another. First and foremost is just about there's not an infinite pool of capital. So I look at this more from I like in Nelson's book where on page 48 talks about there's a finite pool of money that's out there in the world, and where that money is being stored is really where I believe our education to others should start with, which is just there's a dollar, and there's dollars that are flowing into someone's system, and why not have it be a system that you can actually control, that you're not even realizing. We all maybe have not realized until I've had to rethink my thinking, even as a practitioner,
Mm-hmm.
that even by depositing my money into someone else's system, I've now abdicated control of that money. So why I speak into this is that when it comes to, you know, every company needs some form of capital, whether it be, using credit, using banks. And what I'm thinking about in all of, like these concepts is um there's a place where money needs to be stored. Um and what I'm thinking about is, like, when it comes to paying off debts using velocity banking, is that I think I'm just speaking for myself, is that I'm constantly reorienting to the longer term thinking, because this could be these concepts could become transactional in nature, where people feel like there's short term solutions to, um, I have all this credit card debt, and I'm just gonna open up one of these accounts and I'm gonna pay it down, and then I'm gonna be all set. And it's really, again, this long-term thinking. And when we talk about when people are paying premiums, they're really making deposits. So whether you're taking your income and depositing it into a bank, or you're depositing it into your bank, it's just the flow of money. Um, and also I come from the mindset of, when I'm building out these policies, because of my framework from Wall Street of asset allocation and having many uncorrelated assets in a portfolio. That's some of where I come from. Um, I guess the point I'm trying to make is that I think it first starts with the rethinking of the thinking, because until we know and someone teaches us, we're going to fall back into what we've been taught from way from the beginning. Because this is a concept that you guys all know has been around for over 200 years. I'm thinking about them for myself. It took me till age 50 to know about something that's been around for 200 years.
Yeah.
So I just wanted to throw that into the conversation.
If I could add a few quotes from Nelson Nash's book, um, just a few things that I've been thinking about here. Page 14, imagination. Uh, the quote at the beginning of the chapter is, "Imagination is more important than knowledge," Albert Einstein. "The infinite banking concept is an exercise in imagination, reason, logic, and prophecy." Whether you're looking at any tool you're looking at, right? You can either break the tool or you can use your imagination and how to use that tool properly. It's kind of how I think about it.
Y'all are inspiring me, and this is why I love these types of conversations in this roundtable format. Let me try and plainly say some things that are sticking out to me. Here's what I appreciate about velocity banking and people that want to talk about velocity banking. They're using their imagination, Adriel. They are thinking out of the box. I like that very much about velocity banking, that the way that it's put out there, at least, is giving people an opportunity to think creatively. And people in general, especially if they, run up against a wall, they tend to perhaps become more open-minded. Hey, maybe there's a different way to do this, a better way to do this, etc. Right? So I love the creativity that takes place because of that. Imagination is so important for. And then here's what I love is that it can lead them to even better things, which for me is infinite banking, right? Because like I said, I've had people land on my calendar because they started watching so and so on YouTube talking about velocity banking, and then that led them to learn about infinite banking or be exposed to infinite banking, and then they find the book or my calendar. So that's what I appreciate. Here I would like to plainly say too, and y'all said it so well, the short range thinking behind velocity banking versus infinite banking. Transactional was the word you used, David. I like that very much. This is just a one-time, a transactional. I need to get out of this rut. I need to do this. Very transactional, very short range. Oh, I got to do this, in the next month or in the next year. Right? Versus infinite banking, which is a complete paradigm shift. So instead of this transactional thing to, okay, this is easy to do, okay, this is going to allow me to be a bit more efficient. And it could be those things. It could be the case that by doing something creative in finance, using a bank product, that you could save some money or not pay so much interest or whatever. I'm not saying that it doesn't do those things. But here's what I would contrast that with. I would contrast it with a complete paradigm shift to seeing that that's still in the matrix. I want out of the matrix. I want to do something completely different, not just this year, not just this month, not just for me. In fact, I'm looking to do something that's going to impact my great-great-grandchildren. That's what I'm doing today, right? So I think that it just flies in the face of, if we could agree on Nelson's principles, like I mentioned them earlier, and then also if we could recognize the human problems, right? Here's what I don't think that velocity banking addresses: Parkinson's. It's transactional, right? It's transactional. That doesn't address Parkinson's law. That doesn't mean that I'm going to quit spending all that I earn. No, I've got to address Parkinson's law. How about that golden rule? Where am I building gold, right? Yeah, I think you also mentioned earlier, David, where am I building? You might not have said the exact words, warehouse of wealth, like literally quoting, but you alluded to it if you didn't even say the exact words. What about that golden rule? Where am I building capital? And what's that capital doing or not doing for me, right? Because again, Adriel, Einstein's, accredited with that saying about compound interest as well. He who understands it earns it, he who does it pays it. Well, if we're playing by the bank's games, doing this velocity banking thing, maybe that satisfies this short-term transactional thing, but the banks are earning the compound interest the whole time, regardless of, what tools or etc.
Yeah, if you implement velocity banking in the traditional way, are you building gold or are you building something else, right? Because gold is liquid. You can use it.
Well, you are in fact actually you are building a stored warehouse of gold, but that gold is again going towards the reducing of the volume of interest that you're going to invariably going to pay to somebody else. So I can make the argument that Jesse and Adriel, that you actually maybe are in marrying the two, that you can actually still house the gold. It's just where the gold's going towards and how you leverage the gold.
Yeah, I was thinking what you said too, Adriel. And David, even before we get to, say, marrying the two together, even if we just looked at velocity banking, I think that somebody could make the argument, well, no, I'm still building up equity somewhere in something that I own. I own the home, kind of do, kind of don't, right? But again, even in that scenario, you got to recognize, well, who controls the collateral in that whole relationship? Well, the bank does, right? Yes, do what now?
You can't make the rules on that.
Right, they control the leverage, so they're making the rules, and the interest is still going down. But I could still see on the other side of the coin, in defense of velocity banking, I could still see that, well, no, I'm the one in control. I am building, equity that I can use because it's my home. I think that's what somebody could say. And there, within measure, there's a point to be made there. Now, when you do marry the two together, David, I mean, for sure. And that's why that's where I go back to. If somebody decides to, implement both concepts, is having access to capital, even if it is in a home, is that a bad thing? I don't think it's a bad thing. I, in general, think that the more options an individual has, the better off they are. Now, philosophically, I still have the viewpoint that I don't want to do business with banks. But having it as an option, is that a bad thing? No, I think that's a good thing for the individual. But again, just depending on how far out you want to walk, that matters. Because do I want my grandchildren to have a home that they have to ask a bank for permission to leverage it? Do I want that to be the case? No. I want the case to be that we build a private family banking system that permeates generations to where nobody ever has to go or even wants to go play that commercial, conventional game with banks in the future. That's what I'm looking to create. Does that make sense? Did I explain that well?
Yeah.
Yeah.
I think so.
Because now, Jesse, what you're introducing into this conversation is the longer term thinking of why we put in front of people and educate them on IBC is, you know, thinking long term is like generational thinking, and then we get into family banking. So thank you for reintroducing that into the equation, because I think sometimes what gets lost is at the end of the day, this is protection you're creating, not just for your immediate family, but for your future family that you don't even, that's not even in existence yet. And the implications for what we put together, how it's multi-generational.
Yep. Yeah, I'm not trying to make the argument that somebody couldn't improve their next 12 months if they implemented velocity banking. But what I would like to bring us back to always is, yes, what do I want the generation that isn't even here yet? What could their financial footprint look like if they didn't have to start from scratch, like me and my wife started from scratch? When I was introduced to infinite banking, me and my wife both had careers, but we had student loans, the car note, the credit cards. We were trying to, we had our second son, and we had just started from nothing. We started from scratch. Why? Well, because the generation before us started from scratch, because the generation before them started from scratch. So I want to break that cycle. And I just don't think that just the transactional implementation of this easier, short-term, efficient way of doing velocity banking answers that multi-generational desire that I have. That's what I think. Adriel, you look like you had something else right there, buddy.
I did have a couple of thoughts. You were talking about where you build the equity, what the system is that you're using, and the importance of that. It reminds me of when we started infinite banking, my dad was telling our CPA about it. And he's like, man, I don't know about that. He's like, I have some wealthy clients and none of them do that. So I don't think that's a good idea, right? A few months later, he got the HELOC, and the CPAs asked him, hey, what's with this HELOC? Well, back to the life insurance, he said, the idea is becoming your own banker. My dad threw that phrase out there, and he's like, man, I don't know about that. He gets the HELOC, and my dad's telling him about that strategy, and he's like, whoa, that's really cool. That's how you become your own banker. But I think it was just close enough to something that he could understand that made sense to him. But life insurance, you're doing the exact same thing. You're just building the equity in a better location.
With different owners.
Exactly. Yep.
And it also sounds like your father's CPA was definitely suffering a little bit from the arrival syndrome, because
absolutely
he wasn't aware of what, if it's properly structured, what a whole life policy could be used for.
Right. Or at least yet, right? My question with anybody is always going to be, are you willing to read this book? Are you willing to put, $25 down for your financial growth? And if your answer is no to that, can't help you. If it's yes, well, you have an opportunity now to learn, right? Is there anything burning in y'all that you just got to get out there on this topic? Is there anything that I haven't asked or we haven't brought up that you feel like needs to be driven home about velocity banking, infinite banking, their contrasts, where they can be congruent?
Are we going to go into talking about how they can be used as a monthly system, like the Kate method?
Tell me. Run it. I'm ready.
All right. So the way I see marrying infinite banking, and I'm sure infinite banking and velocity banking, and David, I'm sure you could jump in on this, is I was using my imagination to think of how to fund my policy, right? Because the premiums were just getting to be too much. I was taking some loans out. Some of those loans are non-performing. So like, how do I get the most income possible into my life insurance in the form of premium payments and in the form of loan repayments? And I came around to the method of putting all of my expenses on credit cards, And then about a week before my credit card payments are due, I take a loan out. I go into my credit card accounts and I add up the balance of each one. And then I take a loan from my life insurance for that amount. And then at the end of the month, when my paycheck comes in, I put 100% of that toward PUA. And this month, I made my second to last PUA payment for the year. Next month, my paycheck is going to be split between PUAs and loan repayments. And then I'll be making loan repayments until my anniversary date in April. And then after that, I'll roll it right around and start making PUA payments again. But that entire time, I'm making those monthly loans for my credit card payments. The danger with it is you have to make sure that you're putting in more than you're taking out.
All right, I have two questions, but I'm giving y'all space and time and quiet to jump in on that.
So are you designating, Adriel, all of your, well, if I heard you correctly, you're actually, to the letter of the law, you're actually like, as Nelson Nash, you're actually putting most, if not all of your available monthly income and dividing it accordingly?
Yes. Yep. Now, Nelson's rule is premium, right? My loan repayment is not a premium, right? But up until the point of when I reach my MEC limit with my PUAs, I am putting 100% of my income up to that point. So if I do that for half a year, 50% of my income is going toward PUA, right? So then I can kind of see how much of that income is actually going toward PUA.
Okay.
So you're putting a significant percentage of your cash flow towards your PA. You're trying to max fund your policy, build it quickly, and then when you reach that limit, you're pivoting over to policy loan repayments.
Correct.
Yep. So the two things that stuck out to me about what you said that I think would make for a terribly interesting conversation, and I'm still trying to decide if it's going to happen right now or if we're going to pivot, but you said premiums became too much. I think that's worth a conversation, and not necessarily to field it with you for you either, Adriel. Although it could have its benefits for us to talk through, what we just heard, but for the benefit of other people, right? Because I know for me, the appropriate amount of premium is a significant part of conversation in my process, to where I'm answering people's questions about infinite banking, but then we get to that point of what does application look like for them, meaning implementation. And sometimes folks have an idea of what range of premium, they might want to be building into a policy or policies, but very often they have questions. Well, what is appropriate for me, right? And I think that by doing a lot of upfront conversation, you can hedge off problems later on with paying premiums in a long range basis. So I'm just trying to say that here for the benefit of everybody that's still vetting this concept. Policy design matters. It should be built for the individual. And I believe that it should be built with a lot of flexibility, meaning to be able to accommodate a lot of, if not all, obviously, worst case scenarios and best case scenarios. Like in my opinion, there should be a lot of flexibility in a policy structure and somebody's planned use of that policy to account for future windfalls, growth, income increases, etc. And also be built with enough flexibility to weather the storms that life brings as well, right? Like the ups and the downs. Does that make sense? So I don't know. That's just something that my ears pricked up when you said premiums became too much. And then the other thing of the non-performing loans. All right. So you've taken some loans, and you don't have to give any details here. Again, I'm just using what you said as an example, hopefully to speed up other people's learning curve. I think that we should all anticipate Murphy's Law in applying infinite banking or velocity banking or anything. Things are typically going to take longer than we think and costs more than we think. I just believe that if that's our mindset, then we're at least mentally prepared for, oh man, this is going to take twice as long as I thought it was going to take. Or, oh man, that did not go the way that I hoped that was going to go. That is non-performing, right? So just having a policy that's built well enough to weather those ups and downs, but then also us being educated and mentally prepared for those ups and downs. All right. Those are the two big things that stuck out to me. Any thoughts there?
I had one thought. I mentioned that premiums became too much, and that's not necessarily that I can't make the minimum, right? But I want to be disciplined enough to make the maximum, and that bothered me. So I was thinking, how can I manage my, I think things just got too complex for my simple brain to think about saving up for my annual premium, to think about every loan that I took out for personal big ticket items, right? Just managing all that. And it became simpler. And I'm open to you guys saying, dude, you're way off track. You need to structure your system a little bit better. But it just became simpler to me to think, hey, let's do velocity banking and just simplify things. We've got an inflow, we've got an outflow.
So if I could jump in, what I normally make sure as I'm, personally designing a policy and going through, everyone, like their inflows and their outflows of money, is to make sure that they understand that at all costs, we as practitioners, we're gonna build a policy that's going to bend and weave, because life is going to constantly be flowing. So there's always going to be what we call, and you guys know this, a minimum payment. And I call this like a break a glass in case of emergency level of the policy design. But I'm always stressing that this is a last resort, and I'm always going to push you in a good way to make sure you're capitalizing on your system as much as possible without it getting in the way of your day-to-day lifestyle and expenses and things you need to do. So I just want to throw that out there in terms of like policy design. There's always going to be a minimum and a maximum. I'm always going to try to steer people towards the mid-range and upper range, because that's the longer term thinking. But I think that's important for the audience to know, and hopefully you guys maybe are also designing in the same way. There's always going to be, like Jesse, as you say, the life, life does not go in a straight line. It's always peaks and valleys, and your system should be able to accommodate those peaks and valleys.
I intentionally, when I built my policy or had my agent build my policy, I built it too big because I want to push myself, right? I knew that I believe in infinite banking enough that is going to be the thing that propels me through life. So I gave myself a challenge.
I love that. And typically speaking, of course, you're nowhere near your peak income earning years either. That's ahead for all of us, really, right here. Maybe we're right at the verge of it, but it's actually still ahead of us, which is just something to keep in the back of your mind, right? Or that an agent should keep in the back of their mind. I definitely don't want it to feel like I was coming at you. I was definitely trying to use you as an example because you gave us good topic points, but I'll put myself out there by saying too, though, that I've experienced something, Adriel, with one of my policies, and I believe I'll release this on an episode that I'm having come out soon, where I'm actually going to talk about some mistakes of mine that I've made with infinite banking over the years, because hitting a decade of application has really made me reflect. I'm just in a big season of reflecting. And so one of my policies, I learned this the hard way. There came a year where there was some cash flow restrictions in my life, and I did not get to pay the full PUAs on a particular policy that year. And I didn't know this till after the fact, that by me paying less premium that year with that company and that policy, etc., that it meant that in subsequent years, I was not going to be able to pay the amount that I used to be able to pay into that policy. And I learned that the hard way, right? And that's a mistake that I made along the way. So I definitely, yeah, wasn't trying to come at you, but I think those topics that you just naturally brought up are good and worth evaluating. All right, anything else?
Yeah, I was just gonna layer in a couple of things too, I guess. So I think a lot of times, we and I know this is I'm speaking personally for myself, is shifting that mindset of thinking of premium as a payment and shifting that to its capitalization. So I'm capitalizing for my future, for my family's future. And it doesn't matter what type of premium it is, whether it's PUA, whether it's the base, it doesn't matter. Premium's premium. So that being said, I'm capitalizing for the future. And when I start thinking about it in that way of this is my money, I'm putting it into a system that's extremely efficient in the long run. And once I get to this point of like um, almost like where the steam is being built, as Nelson has used in his examples, once that steam's generated, that never stops. And the only thing that stops it is me passing away. So, at least for the policies that are on myself. So that just continues to build and build and build and build, and it only accelerates. So a lot of times we don't think about it in those terms. We're thinking in the here and the now, and we're saying, oh, well, how am I going to generate this payment? Well, it's not a payment. This is me capitalizing my future. So how can I capitalize my future? What can I do? What can I shift to make that happen? And that's really helped me a lot in my own thinking to be able to think about it differently. And I would say for anyone who's listening or maybe just starting out, that is a hard concept to get across. So I will tell you, it's taken me a while to get to there. It's not something that just happens. You have it. It's all about, you know, rethinking our thinking, and that really helped a lot. Um, it's not as well. I don't want people to think about, oh, well, you're just so far into this, you drank the Kool-Aid. It's like, not really. When you really look at it, that is what is happening. And that's the way those contracts are designed. That is how they actually work. So this isn't a situation where it's like, oh, well, you just have done it long enough and that's just the marketing speak that you use. It's like, no, that is not the case. It is actually there. You can see it happen. So I find ways to, you know, try to understand like where does premium potentially exist that I can pay. And I do have a couple of policies, and I think this probably ties into what you're talking about, Adriel, is in the next probably 2 or 3 years, I don't know exactly where that full PUA payment's going to come from. But that's okay to me because I have that amount of time to be able to say, where am I going to generate that income? I know I can make it happen. I just need to do it. Yep. So it's a way of challenging myself, of getting myself to, or working with my family, starting business, doing whatever I need to help make that happen. Because that capital is super critical to my family and my long run legacy that I have or the plans that I have for my family that way. So just my thoughts as I was kind of thinking about some of what you guys are talking about.
You inspired me. Can I run a question by y'all? Can I get some feedback here? Your commentary on the steam, Rob, made me think about this. Would any of y'all think that your children or grandchildren, or that your clients' children or grandchildren, if we implement infinite banking and do it well, right? We don't have to think too much about this. Like Rob says, like we actually know. We're living it out. We know. But do we think that our children or grandchildren would even have it on their radar to go and get a HELOC to go do creative things in their business or their life or whatever, if we've already got this private family banking system where we've got, and I don't want to say numbers, like I kind of want to say numbers here, right? I mean, but I'm not trying to wow people, and some people would say, oh, those numbers are too small, right? So like numbers are just, but if we had millions in death benefit currently, and if we had hundreds of thousands, tens of thousands, like what, but whatever it is, of accessible liquid capital as a family, do our children or grandchildren, do they even think about, do they even wonder, should I go get a HELOC? Or do they not just tap into the family banking system?
Well, to answer that, if I could jump in, is that that's going to be the educational piece and also the family meetings and such that where there's going to be financial stewardship that's going to be taught. And so at that point, when the future generation, they're already going to have a mindset of banks. We don't need the banks in our lives because we've already created our own. So I think what Jesse, what you're speaking into is like just the educational piece and also, financial stewardship and then our obligation to continually educate our own families and then our future generations. So that way that everything they're accountable and they're aligned with the mindset so that will be part of the legacy that we all leave for the future generations is the responsibility that we're going to be putting onto their shoulders by building up this banking system that's not just for the immediate family but for the family at large going forward. So I think really, I mean, to me, I just think about the education and the continually having it be a regular conversation, whether it be, you know, something that's on a calendar that where we like there's a regular meeting that's involved, but it's all about the education and then putting forth the philosophies from a family standpoint, what our values are. And that's what I think this speaks into.
Mm-hmm.
So that they don't even think about, they may be at some point, we're going at 100 years and jet propulsing ourselves to the future. Like that won't even be in their, they won't even pay attention to it because they already know they've already been insulated and they've already been protected and they already have it in place, hopefully.
Absolutely.
I fully agree with that, David. I think that's a great way to think about it in that long range is my initial thought is like, one, we're creating a system that can go on in perpetuity for virtually forever if we take the time to educate our next generations and spend that time with them, help them to understand why. And the why is critical, right? Why do we do this? Well, it's for reason A, B, C, and D, and it ties into our family values. These are the things that we stand for. We have that as our fundamental foundation that we're building from. It's like, oh, well, why would I want to do it any other way? That's like betraying our family values, so to speak.
Yeah.
And that's the way I kind of think about it, at least at some level. But the other side of it, and this can be more towards the economic side of things, how much longer is our currency going to stay put, right? Like we don't know that. But in this system, the currency doesn't matter because there's real intrinsic value. There's real reserve. So regardless of what happens to our nation, 200 years from now, I know James, quoting James again, he said like at the end of the world, you're going to have true mutual companies, and then you're going to have cockroaches and stuff and scorpions. So like if we think about it in that aspect, we're creating a system that can live on for virtually ever if we take the time, like you were saying, David. We got to take that time to let people know how and why this is structured and what you do with it. And I think if we do that the right way, we're going to create a system where they never have to think about it. It just becomes part of how we operate.
Yeah. That makes me think of a few things. Makes me go to the Bible. Makes me think about Philippians 4:8. Think on good things, right? It makes me think about raising my future family. You guys have all raised children. I think David has. I'm not sure. I haven't raised children yet, but I think a lot about it. And there's certain things that my children are not going to know about the world, right? Because they don't need to know about it, right? They don't need to know the evil that's out there. My children may not know that conventional banking exists until they're in their mid-20s, right? Until they're my age, right? Because they're going to know our family banking system is how the world works.
Yeah, it'll be a foreign concept, which
It'll
I
be
think
completely foreign.
it's
And
an
then when you
amazing.
see it, like anything
Yeah,
else in the world, like any other evil in the world, when you see it, you can recognize it. When
yeah,
my children first learn about conventional banking, they'll see it for the evil that it is.
Your kids will look at conventional banking like the CPA you were talking about. Y'all do what?
Yeah. Exactly.
It'll be a foreign concept to them. Well, I mean, I think that's right, David. The education and the communication are such integral pieces for whatever we're going to do, for whatever we're going to implement. For me and mine, infinite banking as a paradigm, infinite banking as the foundation of what we do financially speaking. And so again, these guys' contact information is going to be below in the show notes where you can connect with them, be coached by them. If you're working with me, you can always reconnect at durhamtalents.com. My hope is that you learn to live and leave a lasting legacy.
David, you're in New York?
New Jersey.
New Jersey. All right. Same thing.
Kind of not really, but it's okay.
New Jersey. You just said some fighting words, Adriel.
Yeah.
What are you doing?
Forget about it,
What are you
Adriel.
doing?
Forget about it.
Get out of here.
Wise guy.
Yeah. What are you? Some kind of wise guy? Huh?
Yeah. Do I make you laugh? What about me makes you laugh, huh?
Jesse, I'm really impressed with your New Jersey accent there.
I haven't practiced it as much as I maybe will with David being around and then you instigating stuff here amongst us. So maybe you're going to give me the now I have used my mobster voice some. So it just depends on how mad you make me and David. Then I'm going to jump over into my mobster voice. And it's going to be all about business, right?
If this video was valuable to you, make sure to let me know with a thumbs up, and I'll see you at durhamtalents.com. Live and leave a lasting legacy.